On December 10th, 2025, just one single announcement out of Washington, D.C. set off this massive financial chain reaction. I mean, in just a few hours, we saw the price of gold surge, a wild frenzy of corporate takeovers, and a huge shift in the bond market. So let's dive in and unpack what exactly happened on that crazy day. It all kicked off with a shimmer in the commodities market. All of a sudden, the price of gold just shoots up, climbing over $4,200 an ounce and getting really close to its all-time record high. Now, this wasn't just some minor blip on the radar. This was a serious move for an asset that's been a store value for literally centuries. So what on earth caused it? At the exact same time, in boardrooms all across the country, a whole different kind of chaos was breaking out. We're talking about a wave of mergers and acquisitions that just swept through the market, with billions, that's with a B, billions of dollars in deals announced in a single day. What was fueling this sudden hunger for takeovers? And then you've got the bond market, the bedrock of the entire financial system. The yields on government debt, which affect everything from your mortgage to your car loan, just took a totally unexpected turn. So okay, let's recap. A record high gold price, a massive surge in corporate deals, and a huge shift in the bond market. What's the one thing that connects them all? Well, the answer comes down to one single, incredibly powerful institution, the U.S. Federal Reserve. Yep, on December 10th, their actions were the epicenter of all this market madness. So, what is the Fed really? Well, here's a good way to think about it. Imagine the U.S. economy is this giant, super complex car. The Fed, they're the driver, and their whole job is to know exactly when to tap the brakes to cool things down and when to hit the gas to speed things up, all to make sure the economic ride is as smooth as possible. So how does the Fed know where to steer? They've got a roadmap, basically a clear mandate from Congress with two main goals. Number one, keep prices stable, which means keeping inflation in check. And number two, aim for maximum employment. It's this incredibly delicate balancing act, and every single decision they make is about trying to keep those two often competing goals in perfect harmony. And that brings us to the main event of December 10th. After weeks of everyone holding their breath, the Fed was finally about to announce its decision on interest rates, which is by far their most powerful tool for steering that economic car. And then the news dropped. The Fed was cutting its main interest rate from 4.0% down to 3.75%. Now, I know that might not sound like a huge change, but in the financial world, a quarter of a percentage point, what they call 25 basis points, that is a really big deal. So, what was the thinking here? The answer is really in the Fed's own crystal ball, their economic forecasts. They had actually raised their prediction for economic growth up to 2.3% for 2025. But at the same time, they were lowering their outlook on inflation. So, with the economy looking stronger and price pressures easing up, the stage was basically set for a rate cut. And the Fed chair himself gave us a little peek behind the curtain. During the press conference, he basically said the debate inside the Fed wasn't about if they should cut rates, but by how much. For the markets, that was a massive signal that, hey, more rate cuts could be on the way. And that brings us right back to where we started, all those market reactions. The Fed's decision was like a stone thrown into a pond, and now we're going to trace those ripples as they spread out through the entire financial system. Okay, so the very first, most immediate impact happens in the bond market. It's almost automatic. When the Fed cuts its key interest rate, it tends to drag down the yields on government bonds. It's a really direct and predictable chain reaction. And that's exactly what we saw happen. In response to the Fed's announcement, the yield on the benchmark 10-year Treasury note, which is a really important one, fell to about 4.15%, backing away from what had been a nearly 3-month high. The bond market's reaction was swift, no question about it. So what in the world is the connection between government bonds and a lump of gold? Well, it all comes down to returns. See, gold doesn't pay you anything to own it, no interest, no dividends. So when the interest you can earn from a super safe government bond goes down, the appeal of just holding gold goes up. All of a sudden, that non-yielding chunk of metal looks a whole lot more attractive. And just like clockwork, as those bond yields dropped, investors piled into gold. And that's what drove its price right up to $4,228 an ounce. This inverse relationship is a really key piece of the puzzle to understanding what happened that day. All right, so that explains the gold, but what about that surge in corporate deals? Well, it's pretty simple. Lower interest rates make it cheaper for companies to borrow money. And cheaper money often leads to a boom in mergers and acquisitions. We saw it play out right in front of us with a bunch of major deals, like Creative Planning's $900 million acquisition, all of them fueled by the promise of more affordable financing. The Fed's decision obviously had a huge impact on U.S. markets. But here's the thing. In today's global economy, those ripples don't just stop at the border. What the U.S. central bank does has major consequences for the entire world. And this is where things get really interesting. You see, while the U.S. Fed was cutting rates down to 3.75%, the European Central Bank was doing the opposite, holding its key rate steady at 2.15%. We're literally watching the world's two biggest economies head down two very different paths.
And this split raises a huge, critical question for the global economy. I mean, will one strategy end up being more successful than the other? And what does this divergence mean for market stability down the road? It's just a powerful reminder that whenever the Fed makes a move, the entire world feels the tremors.